Alright guys, today's video is one you absolutely do not want to miss. Wall Street veteran Tom Lee just dropped some serious gems on CNBC. According to him, this market rally has already passed every major stress test thrown its way. Geopolitical shocks, interest rate fears, inflation panic, you name it. And despite all that, stocks are pushing higher. Lee says it's not the institutions leading the charge, it's retail investors. The very folks the media often writes off are the ones who saw the opportunity early, while the so-called smart money is still sitting on the sidelines, scared and cautious. His words, retail is buying, institutions are scared. Guess who's winning? That's powerful. So in this video I'm going to show you the clip of Tom Lee breaking it all down. Then I'll give you my full reaction and personal take on what it all means for us as investors right now. And to top it all off, I'll dive into one of the best high-performing growth stocks you need to have on your radar immediately. Because if Tom Lee's right, there's still serious upside ahead. If you only watch one video today, this is the one. Stick with me till the end. Hit that like button. Let's aim for 1,000 likes on this one. Share it with anyone you know who's investing. And if you're new here, subscribe and tap the notification bell so you never miss out on critical updates like this. This video is sponsored by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Alright, let's roll the clip. Here's what Tom Lee had to say.
Joining us here at Post 9 is Tom Lee, Fundstrat Global Advisors, Head of Research, and Fundstrat Capital Chief Investment Officer, also a CNBC contributor. Tom, it's good to have you. Welcome. Talk about confounding expectations, wouldn't you say? What do you make of this morning's action?
Well, in some ways it's not a surprise because, as you know, like Art Cashin had the adage, sell the buildup, buy the invasion. And I think today is an example of that markets were kind of already nervous and anxious, and we've already saw de-risking, and the VIX was already elevated. So I think in some ways this is probably pretty typical.
Does it change your call for the rest of the year at all? And you think it displaces any other priorities or has any effect on bill passage or how that might get constructed?
In some ways, it actually strengthens the case for stocks to do better into year-end, because at the start of this year, we would have said U.S. bombing a nuclear facility is a black swan. Oil would be 120, stocks should be down 10%. And then we have the event, and oil is not really surging, and stocks are up. So I'd almost say that you've put another stress test into the market. We've seen it pass it, and I think it means stocks should do pretty well into year-end.
Do you think Hormuz remains a risk?
I do, but Brian Sullivan was off camera was mentioning a lot of strategic reasons why that may not be the case. I'm sure he's going to have his views, but I would say I'm watching oil, and if oil isn't surging, then I think it just means that the risk of the straits being closed is lower.
I guess when you think about the impact for U.S. stocks and bonds and the dollar, it comes down to growth and inflation expectations. And the key, Tom, is whether either of those things have changed in light of recent geopolitical events.
Yeah, and as you know, core CPI doesn't include energy. And as you know, when the ECB looks at core inflation, they exclude housing. Housing is not part of ECB's core CPI, and they're cutting. If you calculated U.S. CPI on the same exact basis, it's lower than Europe. So I do think there should be a dovish tilt towards the Fed, or that's the upside opportunity into year-end as well.
Tom, there seems to be a speculative nature to the market that's creeping in again. I wonder if it's a concern. And when I say that, I'm talking about the reception of some of the IPOs. I mean, granted, very well received, but Circle's now got a $62 billion market value. CoreWeave, almost $90 billion. You got a lot of SPACs coming back. I don't know if you've seen it.
Yeah.
Even Chamath is coming back with some SPACs. Any concern to you or no?
It is. I mean, those are echoes of 2021, which is some stocks get fantastically bizarre valuations, and I'm not naming any. And
you want to name some?
And then there is signs of speculation. And but the one thing that was true in 2021 that's not true now is when I meet with fund managers, in 2021 they said there was no stock they could buy because everything was expensive. That's actually not true anymore. Now the people I talk to are saying, look, the numbers have been better and numbers are going up, but the macro is making them uncertain. So there's actually a lot less risk taking by institutional investors.
So to the extent a speculative part of the market is something you monitor, it's not hitting a level that is that concerning to you?
Yeah, I mean, to me, David, it's a sign that the cohort that is speculating are the ones that bought the dip in April. As you know, it was retail, the Robinhood community, that was buying in April when institutions were selling and raising cash, and high net worth was raising cash. So it's the same crew now that is buying, the circles at one times assets under management, which is tremendous. But it's not speculation to me yet, because I'd say high net worth is not really that invested, and institutions are still pretty cautious.
But what is the underlying view that you have that makes you bullish? Is it that the economy's hanging in? Is it that earnings are picking up?
Well,
what's the fundamental reason?
I think when we look at macro, on the margin, things are better. We have better visibility on tariffs into 2026. We have regulation and tax, legislation visibility into 2026. I think the Fed is now being questioned about their unwillingness to cut. I mean, it was apparent 5 out of the 10 questions during the press conference were about that exact question. So there's a dovish Fed. I know consumers are overly cautious right now, but as you know, inflation expectations are far above CPI. That's a positive surprise if delivered inflation's lower. And then businesses have been really resilient. I think actually the economy might be weakening, but earnings have been better. So overall, with all the cash on the sidelines, I would say we should be quite bullish, actually.
Tom Lee starts off by talking about how today's market action, despite recent geopolitical tensions, isn't actually that surprising. He references the old Wall Street adage, sell the buildup, buy the invasion. Essentially, markets often price in fear before a major geopolitical event even happens. And by the time the event does occur, a lot of the panic is already baked in. So when we didn't see oil prices spike and stocks actually moved higher, Tom sees that as the market passing yet another stress test. That's a strong signal. Now here's where it gets more interesting. Despite headlines about U.S. airstrikes on nuclear sites, something that would have been considered a black swan event earlier in the year, stocks are up, not down, oil isn't going crazy, and instead of crashing, the market is stabilizing. This suggests the system is more resilient than many thought, and Tom says this actually strengthens the bull case for equities heading into year-end. Then the conversation shifts toward inflation, and Tom drops some key insight here. He reminds us that core CPI in the U.S. doesn't include energy, and when you align our inflation calculations with how the European Central Bank does it, excluding housing, the U.S. actually comes out looking better than Europe. The ECB is already cutting rates, which begs the question, why isn't the Fed doing the same? Tom sees this disconnect and believes it presents an upside opportunity for U.S. stocks if the Fed ultimately shifts its stance in a more dovish direction. Next, Tom addresses the reemergence of speculation in the markets, particularly with high-flying IPOs and even SPACs making a comeback. He acknowledges the return of some 2021-style behavior, companies achieving bizarre valuations, but draws a clear distinction. In 2021, fund managers told him there were no cheap stocks. Today that's changed. Institutional investors now say the fundamentals are looking better, earnings are beating expectations, but macro uncertainty is what's holding them back. In other words, they're cautious, not euphoric. That tells Tom we're not in a speculative bubble yet. And who's doing the buying right now? It's the same crowd that stepped in back in April. Retail traders, the Robinhood community, they were buying while institutions were sitting on the sidelines. So Tom's saying yes, there's speculation, but it's isolated. Big money is still mostly underexposed. That's actually a bullish setup. Then comes the big question, why is Tom Lee still bullish? And here's where he really lays it out. So, Tom Lee's thesis is this. The market has passed multiple stress tests, geopolitical threats, rate fears, and inflation panic. Yet, stocks are holding firm. Institutions are still cautious. Fundamentals are improving, and the Fed may be forced to pivot sooner than expected. All of this paints a compelling picture of a market that wants to go higher and might just need a little push, like a dovish Fed or another earnings season beat, to really break out. Now, if you're an investor watching all this unfold, here's the key takeaway. Don't let fear keep you on the sidelines. This isn't 2021 all over again. The fundamentals are better. The opportunities are real. And according to Tom Lee, the market is already moving ahead of the Fed. So, will you move with it, or wait until everyone else piles in? Let me know what you think in the comments. Hit that like button if this breakdown helped you, and don't forget to subscribe for more reactions and stock insights like this one. Now let's dive into the stock that could anchor your portfolio and help you retire wealthy. The best high-performing growth stock to buy now is Teladoc Health Inc., ticker TDOC. Teladoc is the global leader in virtual healthcare, reshaping the industry. It connects patients with doctors, therapists, and specialists. No waiting rooms, no hassle. Teladoc's mission? Make healthcare accessible and affordable for everyone, everywhere. Operating in over 175 countries and 40-plus languages, it's a one-stop shop for virtual care. Teladoc covers everything from colds to chronic conditions and mental health. Their brand is trusted by millions of patients and thousands of employers. What makes Teladoc compelling now? Its strategic position post-pandemic, leaner, smarter, and more focused. Their data-driven platform delivers better outcomes and creates a sticky ecosystem. They're not just a tech company, they're a healthcare company powered by tech. The market is sleeping on this giant, and the stock is trading below its long-term potential. Let's dig deeper into what makes this company tick. Teladoc's power comes from two massive growth engines. First, BetterHelp, the leading online mental health platform, connecting millions to licensed therapists. Demand for mental health services is exploding, and BetterHelp dominates with a subscription model and recurring revenue. Second, Teladoc Health Integrated Care, the B2B backbone, offering virtual medical services to employers, health plans, and hospitals. From general consultations to chronic condition management, Teladoc's whole-person care sets it apart. The synergy is huge. Users enter through one service and are referred to others, locking them into the ecosystem. This cross-selling increases lifetime value and makes Teladoc indispensable. BetterHelp captures the direct-to-consumer market. Integrated Care anchors the enterprise side. These segments complement each other, driving growth from every angle. As digital health accelerates, both engines are primed for significant growth. This dual approach gives Teladoc diversification and market coverage competitors can't match. That's what a market leader looks like. Teladoc isn't resting, it's making bold moves. In February 2025, Teladoc announced the acquisition of 𝗗𝗜𝗏 Health, a leader in digital preventive care. This enhances Teladoc's platform, moving deeper into preventive medicine and expanding its moat. Even bigger, Teladoc's collaboration with Amazon, offering chronic condition management to Amazon's health benefits program users. This partnership gives Teladoc massive reach and credibility. These moves are part of a deliberate strategy to build the most comprehensive virtual care platform. 𝗗𝗏 strengthens clinical capabilities. Amazon brings scale and distribution. Management is playing chess, not checkers, aggressively pursuing growth and cementing leadership. This is proactive, forward-thinking leadership. Teladoc is building the future of healthcare, deal by deal. That's a company worth betting on. Let's zoom out. The telehealth market is a tidal wave, and Teladoc is riding the crest. The U.S. telehealth market was $42.5 billion in 2024, projected to grow at nearly 24% annually through 2030. The shift to virtual care is driven by demand for convenience, smartphone adoption, and government support. Teladoc, as the largest player, is perfectly positioned to capture a huge share. Its scale allows for better tech, talent, and deals. In fast-growing markets, the leader takes the lion's share, and that's Teladoc. This is a global trend. Healthcare systems worldwide need solutions for cost and access. Teladoc's global footprint puts it in a unique position for international expansion. As digital infrastructure improves, demand for Teladoc's services will soar. With a market cap of $1.4 billion and 2024 revenue hitting $2.57 billion, it's clear this is still a company with scale. But it's also a company that's been under pressure. With a net loss of $1 billion in the same year, many investors had written it off. That might be starting to change. On June 23, momentum really kicked in after Citron Research, yes, the same Andrew Left-led firm known for calling out mispriced assets, posted a bullish comment on their X account calling Teladoc a coiled spring. According to Citron, the company is now trading at a valuation of just $1.4 billion and could be on the verge of a major breakout. One of the biggest catalysts? The recent acquisition of Uplift, a tech-driven provider of virtual mental health therapy, psychiatry, and medication management services. Teladoc paid $30 million in cash for the deal, but this isn't just another bolt-on acquisition. Citron calls it transformational. Why? Because Uplift gives Teladoc's BetterHelp the infrastructure to finally bill insurance, integrate with Medicaid, embed into employer healthcare plans, and access commercial reimbursement channels. That opens up an entirely new revenue stream. And here's the kicker. At the recent Goldman Sachs Global Healthcare Conference, Teladoc's leadership team made it clear that just a 1% increase in user conversion could generate $40 million in annual revenue. That's not forward guidance, it's simple math, according to Citron. What Teladoc is doing now is removing friction from the user experience, unlocking reimbursement potential, and actually bringing mental health into the center of the healthcare ecosystem. In Citron's words, this stock is an asymmetric long opportunity at these price levels. Teladoc isn't just leaning on acquisitions either, it's been actively working to improve its internal strength as well. On June 3rd, the company announced new inducement awards for incoming employees, a sign it's investing in talent and retention, which could help drive operational efficiency and innovation in the quarters ahead. With executives like CEO 𝗗𝗜𝗏𝗏 and CFO 𝗗𝗟𝗏𝗏 taking center stage at high-profile investor events, Teladoc is clearly on a mission to rebuild trust and reinforce its long-term vision. The recent surge of nearly 17% in its stock price reflects that the market is starting to take notice. While challenges remain, Teladoc is showing signs of real momentum through smart acquisitions, clear communication, and a renewed focus on execution. For investors watching from the sidelines, this might be the moment to start paying attention again. Investing in Teladoc means investing in the telehealth megatrend itself. The convenience and efficiency of virtual care are here to stay. Don't miss this wave. No analysis is complete without hearing from Wall Street. The bulls are excited. 𝗗𝗜𝗏𝗗𝗘's 𝗗𝗓𝗄𝗏 reiterated a buy on TDOC, citing strategic expansion and innovation. Teladoc's programs like virtual primary care and weight management are delivering real value. 32 hedge funds held positions in Teladoc at the end of 2024. Smart money sees value. Hedge funds are betting on Teladoc's leadership in a growing industry, but not everyone's convinced. The bears point to past concerns, competition, high costs, and slowing revenue. Brown Capital Management exited, citing deteriorating fundamentals and questionable acquisitions. These are real risks, but the company's new strategy addresses them. The Catapult acquisition and Amazon partnership show management is steering in the right direction. Revenue growth is stabilizing for a healthier trajectory. The bulls see a clear path to renewed growth and profitability. I'm siding with the bulls. Teladoc's future looks bright. Let's talk about why TDOC could be your portfolio's safe haven. In today's volatile market, investors crave safety. Healthcare stocks like Teladoc can be a secret weapon. People need healthcare no matter the economy. This creates resilient demand for Teladoc's services. Healthcare is often insulated from trade wars and tariffs. Teladoc's focus is US-centric. Even in economic slowdowns, healthcare needs remain constant. Teladoc's flexible, affordable model thrives in any environment. Adding TDOC to your portfolio provides stability and growth. It's a tech innovator rooted in an essential industry, a rare combination. Teladoc offers both upside and downside protection. Don't mistake safe haven for boring. Teladoc is dynamic and innovative. In a world of uncertainty, healthcare is one of the safest bets. We've laid out the massive opportunity in Teladoc Health. Now it's your move. The world of investing is full of possibilities, but it's those who take action and keep learning who truly get ahead. Whether you're just starting out or looking to sharpen your edge, every step you take today can set you up for a brighter financial future. The first step, get educated. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments no matter what the market throws at you. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Next, join our Stocks Galore Patreon for exclusive analysis, timely alerts, and a thriving community of smart investors. You'll get access to in-depth research, real-time updates, and the chance to connect with like-minded people who are just as passionate about building wealth as you are. Link is in the description. Don't go it alone. Let's navigate these markets together. Collaboration and shared knowledge can make all the difference, especially when the markets get tough. Now let's get the conversation started. What's the biggest factor you look for in a high-growth stock like Teladoc? Is it the company's leadership, their ability to innovate, or the sheer size of the market they're targeting? Market leadership, innovation, or market size? Or maybe something else entirely? Your perspective matters. Drop your answer in the comments below and let's learn from each other's strategies and experiences. The more we share, the smarter we all become. Investing is a journey, and every insight helps us grow stronger as a community. If you got value from this deep dive, support the channel, like, share, and subscribe. It helps us reach more investors and bring you even more high-quality content. You don't want to miss the next big idea that could change your financial life. Stay tuned for more insights, strategies, and opportunities to grow your wealth. We're on a mission to find the best investment opportunities, and you want a front-row seat. Thank you for watching and being part of this journey. Thanks for watching. I'll see you on the next one.